This is the Dinar Chronicle, your trusted source for real-time intelligence, global revaluation updates, and inside financial developments affecting IQD, VND, and other emerging currencies. If you've been following the rapid evolution of currency revaluation chatter, tonight's update may be the most compelling one yet. A leaked internal memo from a private Tier 1 banking institution has surfaced, and the contents are nothing short of explosive. The document references a projected value adjustment for the Vietnamese Dong VND, hinting at a new potential rate of up to $5. While this information is not yet reflected on public Forex channels, the language in the memo, coupled with specific downstream instructions, has set the currency community ablaze. The memo, reportedly dated within the last 72 hours, was circulated among mid-tier and senior account managers of a US-based global financial institution with strong exposure in Southeast Asia. It outlines, in technical banking language, preparatory steps for high-value foreign currency redemptions. More critically, a section clearly references VND conversion tables using a placeholder exchange rate of $5. While it stops short of explicitly declaring this as an active rate, the inclusion of such a value in a confidential internal training document indicates that there may be very real discussions underway, quiet, behind-the-scenes movements that point to a significant monetary recalibration involving Vietnam's currency. Financial institutions typically prepare weeks, if not months, in advance for structural currency changes. When confidential memos like this appear, it's rarely accidental. Historically, placeholders have been used in internal systems for rate simulations and operational readiness exercises, but rarely do those numbers get this specific or leak outside institutional boundaries. What adds weight to this development is that it coincides with Vietnam's recent monetary reform policies and digitization efforts that align with IMF modernization protocols. These structural moves, often overlooked in the mainstream, are strong indicators of a country preparing to open its currency to a more competitive global valuation. Multiple currency analysts have pointed out that Vietnam's central bank, the State Bank of Vietnam, has been steadily tightening its foreign reserves, increasing US dollar holdings, and renegotiating trade settlement practices to reduce its reliance on dollar-denominated debt. This would be a prerequisite for any meaningful revaluation to occur. If the VND were to be repegged or moved into a managed float system with even partial backing by hard assets or a sovereign wealth guarantee, a dramatic upward shift in exchange rate valuations would be not only possible, but justifiable under current market conditions. At the institutional level, banks are known to prepare operationally long before any revaluation becomes visible to the public. Staff are briefed. Redemption desks are updated. Digital infrastructure is tested to handle surges in transactions. The leaked memo mentions specific client processing flows, rate sheet reference tables, and limited access protocols, language that indicates more than just a theoretical scenario. There is growing speculation that Tier 1 clients, those with substantial holdings in Vietnamese Dong, may be offered structured private redemptions ahead of a public rate release. This is often referred to in currency circles as a whale window or tiered rollout, and it would explain why only certain internal departments have visibility on the new rate framework. In parallel, several well-placed sources have reported that trading screens used in interbank settlements have intermittently displayed elevated VND rate placeholders, even if they're not yet accessible to retail-level Forex platforms. These screen rates are known to fluctuate during times of pre-market positioning or imminent sovereign adjustments. One such source, a former foreign currency analyst for a regional bank in California, stated that placeholder rates on back-end Swift screens have ranged anywhere between $2.80 and $5.20 for the VND over the past 10 days. While these numbers are not confirmed as live rates, their appearance on systems used by international clearing banks is a strong signal that something is brewing. Adding to the urgency is the sudden silence from financial regulatory agencies, particularly in Asia. The State Bank of Vietnam has not issued any public denial or clarification regarding the supposed shift, despite increasing online chatter and inquiries from major asset holders. This no-comment stance is often observed in the hours or days before formal monetary policy announcements. The Vietnamese government, known for tight media controls and measured financial disclosures, is unlikely to publicly confirm any rate change until it has been implemented at the institutional level. Further fueling the speculation is a sharp increase in VND purchase activity among private investors and international fund groups. Exchange houses in Dubai, Singapore, and certain U.S. locations have reportedly experienced temporary supply shortages of VND notes, indicating a possible coordinated acquisition. These types of shortages typically occur when institutional players begin acquiring high volumes in anticipation of a sudden rate shift. If the leaked memo is to be believed, then these movements may not be coincidental, they may be tactical.